Okay, let's go ahead and get started. Good morning or good afternoon, everyone, as the case may be. My name is Mark Bolinger. I'm a research scientist at Lawrence Berkeley National Laboratory, and I'd like to thank you all for joining me for today's webinar. Before I launch in, there are some logistics to take care of. First, all of you are currently in listen-only mode, so I think the only way that you'll be able to communicate with me during the webinar is by using the chat box that I think is probably in the lower left of your screen. That said, I'm not really planning on monitoring the chat until after I'm done presenting, at which point I will go through and read and try to answer any questions that you've typed in. In the meantime, though, if we do end up having unforeseen technical difficulties where you can't hear me, for example, I would obviously very much like to know about that, and the chat box is probably the best way to try and alert me. So I will keep one eye on the chat box as I run through this, but I won't be following it closely until the Q&A portion. And then finally, as you probably heard, I am recording this webinar, so please also be aware of that as well. Okay, with the preliminaries out of the way, today I'll be walking you through some analysis that I've done to revisit the long-term hedge value of wind power in an era of low natural gas prices. And the reason to look into this now at a time when gas prices are low and when hedging is probably not at the forefront of most people's minds is that as wind power finds it harder to compete with gas-fired generation on the basis of price alone, it may need to highlight or fall back upon some of its non-price attributes in order to help justify future deployment. These attributes include, of course, wind's relative environmental benefits, but I won't be talking at all about those today. They also include wind's ability to offer a fixed price product over long terms, thereby providing a long-term hedge against potential increases in natural gas prices or power prices down the road. This is the attribute that I'll be focusing on today, and I'll do so by comparing actual wind power purchase agreement or PPA prices to a range of long-term natural gas price forecasts. So this will be a four-part presentation that should last about a half hour, not counting the Q&A. First, I'll talk a bit about the wind PPA sample, what it looks like, and what the price data reveal. Next, I'll make the case for thinking of wind as a long-term natural gas price hedge, mostly by pointing out the shortcomings of conventional gas hedging instruments. And then the third part will explore the degree to which wind can provide this long-term hedge in a cost-effective manner, since this is obviously an important consideration. And then finally, I'll conclude with two examples of how prominent buyers of wind power think about wind's long-term hedge value. So I am seeing a few chats come in where people are saying they can't hear. I'm not sure if that's the case webinar-wide. Maybe someone who can hear could just chat me and let me know that they are, in fact, picking up the audio. Okay, thank you. Okay, great. So it seems like a lot of people can hear actually what's going on. So I'm not quite sure what the problem is with those of you who can't hear. I'm sorry about that. I guess I will note that the webinar is being recorded and should be accessible later. Okay, so I'm just going to move on. Let's see. Okay, yeah. So let's start by talking about the PPA sample. Although the history of modern wind power in the U.S. extends back to the early 1980s, our PPA sample is drawn from just those projects that have achieved commercial operations since the start of 1998. Now that's only about 15 years ago, but it turns out that more than 98% of the 60 gigawatts of wind power that's currently installed in the U.S. has been built since 1997. So we're really not losing much by ignoring the older projects. It's important to note that I'm interested only in what are known as bundled PPAs. So in other words, only those PPAs that convey all energy, capacity, and renewable energy credits, or RECs, to the buyer. And the reason for this focus is because when I compare wind to gas, I want to be sure that I'm counting the full revenue stream that's available to these wind projects, at least on a post-incentive basis. I want to make sure I'm not leaving anything on the table or off the table, as the case may be. As a result, I need to exclude certain wind projects from this sample. For example, those projects that strip off their RECs and sell them separately at a price that's not known are excluded from the sample. Merchant projects, by definition, don't have a PPA and are therefore also excluded. I exclude projects in Alaska, Hawaii, and Puerto Rico as likely outliers. And then I also exclude utility-owned and behind-the-meter projects, neither of which typically involves a sale of power on the wholesale market. Okay, before moving on, I'm seeing a few more chats where people are mentioning that they can't hear over the computer, but they can hear if they follow the dial-in instructions over the phone. And so that number is 866-740-1260, and then the passcode is 795-4937. So once I make all of the exclusions that I just ran through, I'm left with 35,370 megawatts of potential samples. So that's basically the total PPA universe that I have available to draw from. My actual sample is smaller and consists of 287 contracts totaling 23,529 megawatts, which it turns out amounts to 67% or roughly 2/3 of the total potential sample. So it is a fairly large sample. It's also fairly broad. I think 29 different states are represented. But it's also obviously not a complete sample. I am missing more than 11.8 gigawatts of wind capacity. And I can tell you that a large proportion of this missing potential sample comes from the state of Texas, where projects located within ERCOT are not subject to FERC reporting requirements. And it turns out that FERC is one of the primary sources for this wind PPA price data. So here we see a regional breakdown of the PPA sample by U.S. Census Division. And the red ovals highlight the fact that 70% of the missing 11.8 gigawatts of potential sample is concentrated in just 3 regions. So the East North Central region, which is essentially the Great Lakes states, the West South Central region, which includes Texas and Oklahoma, and then the Pacific region, which is California, Oregon, and Washington. And again, you can see that the largest chunk of missing capacity, nearly 4 gigawatts, does come from the West South Central region due to the ERCOT exemption that I mentioned. Now, the nationwide impact of underrepresentation within these 3 regions is a bit unclear, but as shown on this next slide, it could be rather minimal to the extent that low and high-priced regions cancel each other out. So this graph shows how levelized wind PPA prices have changed over time. Specifically, each bubble shown here represents a single wind PPA, with the size of the bubble corresponding to the contract size in megawatts, and the placement of the bubble reflecting both the levelized PPA price along the y-axis and then also the date on which the PPA was signed or executed along the x-axis. And you can see here in red, I guess that is, that the West South Central region, which again is the biggest hole in our sample, is generally a low-priced wind region. Recall that that involves Oklahoma, for example, and parts of Texas. While the Pacific region, shown in green, is generally a high-priced region, or at least has been more recently, while the East-North Central region, which is here in blue or purplish, falls somewhere in between the other 2. So it is possible that underrepresentation within these 3 regions cancels out to some extent on a nationwide basis. I also just want to point out the time trend, which is depicted here by the dashed polynomial best fit curve line, and is also shown a bit more clearly on this next slide by the column graph. This time trend in levelized PPA prices closely follows similar trends that we've seen in both turbine prices and also installed project costs. And this at least loosely suggests that PPA prices have been largely formulated or negotiated on a cost-plus basis. So in other words, definitely with a few exceptions, the market does appear in general to be fairly competitive, with PPA prices largely tracking costs for the most part. Okay, the PPAs in the LBNL sample are mostly long-term in duration. The histogram in the upper left-hand corner here shows that 20-year contracts are by far the most common, followed by 25-year and then 15-year contracts. And in fact, 84% of the sample in capacity terms has contracts of 20 years or longer. The pricing structure of these contracts can vary quite a bit from contract to contract, but a full 58% of the sample exhibits flat annual pricing in nominal dollar terms, which of course means that prices actually decline over time in real dollar terms. Another 38% do escalate annually in nominal dollar terms. And the average escalation rate among this subsample is somewhere in the order of 2.4% per year. So basically this escalation rate is seemingly intended to really just keep pace with projected inflation, which in turn means that even these escalating contracts are likely to exhibit fairly flat pricing in real dollar terms going forward. So overall, this is a very stable price sample on average. So here finally we see prices from the entire sample. So all 287 contracts totaling 23.5 gigawatts expressed here as a generation weighted average price over time in both real and nominal dollars, with the blue line being the real dollar time series. The big gray area, meanwhile, shows the sample size at every point in time. So for example, currently in 2013, we are at our maximum sample size of 23.5 gigawatts. But going forward, that sample size will slowly and then more rapidly decrease as contracts expire and projects fall out of the sample as a result. You can see here that on a real dollar basis, the generation weighted average PPA price from among the entire sample hovers right around $50 per megawatt hour through 2035 before dropping rather sharply in 2036 when more than a gigawatts of high-priced contracts in California drop out of the sample. And this degree of price stability, so just the fact that we can look out 20 years and see that energy from wind projects being built today will cost no more contractually 20 years from now than it does now, this of course is a somewhat unique feature of wind power. So the key takeaways from this first part are that we've got a fairly sizable wind PPA sample that exhibits quite a bit of long-term price stability with real dollar prices hovering just below $50 per megawatt hour out through the 2030s. There are significant time trends in the price data, with the most recent contracts in our sample, which in some respects are really the most relevant contracts to this discussion. These exhibit much lower PPA prices than those contracts signed just a few years ago. Okay, before moving on to part two here, I am going to try and just chat everybody, try calling in to the audio line at 866-740-1260. Code is 795-4937. Okay, hopefully that'll solve some people's problems. All right, so now that we've seen the wind PPA price data, I do want to make the case for thinking of wind power as a long-term hedge against rising natural gas prices. And I'll do this mostly by pointing out the comparative riskiness of natural gas prices, as well as the shortcomings of conventional gas hedging instruments. Okay, so we all know that gas prices broke through 10-year lows back about a year ago in April 2012. And although they've risen some since then, they still remain very low by historical standards. One of the interesting things analytically about gas prices being as low as they are is that they can't possibly fall much further before hitting the absolute floor price of zero. So for example, a year ago when gas was hovering around $2 per million BTU, the risk of a price increase of more than $2 was almost infinitely greater than the risk of a price decrease of more than $2. So in other words, gas price risk was back then and still is today skewed to the upside. And you can see that skew in this graph, which is probably easiest to explain by starting over on the right and then working our way back to the left. So the red dashed lines over on the right show the most recent upper and lower 95% confidence intervals around the current natural gas futures strip, which itself is depicted here by the red line made up of individual circles, with each circle representing a different contract along the future strip. The upper and lower confidence intervals are derived from information embedded within the price of options on natural gas futures contracts, and what these confidence intervals tell us is the price range in which the market is 95% confident that a futures contract will eventually expire. Because price uncertainty increases the farther out you go in time, these confidence intervals do widen out over time, forming a bit of a cone around the gas futures contracts themselves. And you can see here that this red cone is somewhat skewed towards higher prices. So in other words, the market believes that there is more room for a price increase from current levels than there is for a price decrease. Okay, so that explains the red lines. If we step back in time by 1 month, so if we move just 1 month to the left, the 95% confidence intervals at that time are shown here by black dashed lines, while the future strip has been replaced by the actual spot price that was realized at that time, and that's indicated here by the blue line. So really, as you move to the left on this graph, you're just seeing a monthly historical record of how these 95% confidence intervals have changed over time. And what you see is that for the past 3 years, the lower confidence intervals have pretty much firmly held the line at around $2 to $3 per million BTU, and this reflects the physical reality of a floor price. So even though spot prices were very low, over this period, the lower 95% confidence intervals rarely dipped below $2 to $3 per million BTU. The upper confidence intervals, though, have been much more variable and have actually come in quite a bit over time as the market has become more confident in the durability or longevity of this low gas price environment. Even so, as I mentioned, you can see that price risk still remains somewhat skewed to the upside. So with gas prices as low as they are and with price risk continuing to be skewed to the upside, it should theoretically be a great time to hedge. The bet is somewhat one-sided at this point, and to borrow a well-known analogy, the best time to buy flood insurance is before the water starts rising. The problem, though, is that the water has already started rising in the sense that the futures curve is upward sloping. So in other words, even though spot gas prices are currently trading around $3.50 per million BTU, you really can't lock in $3.50 gas going forward, or at least not without paying a hefty premium in the options market in order to do so. Instead, what you can lock in at present is the upward sloping futures price curve that's shown here in red, which, as you can see, it trends up to $4 and $5 per million BTU fairly quickly. And even locking in this upward sloping futures strip can be problematic, though, because the futures market is just not very liquid beyond a few years out. Futures contracts are theoretically tradable out through 2025, but in practice, liquidity dries up after just a year or so, as shown on this graph of average daily trading volume and also average daily open interest. And this makes it difficult to trade any sort of volume in the futures market over time. Physical gas supply deals are certainly a possible alternative to the futures market, but these types of contracts are also a bit of a rarity, particularly over longer terms. If you're lucky, you'll maybe be able to lock in prices for a 5 to 10 year period, probably not any longer than 10 years. And also the pricing of these physical contracts will largely follow the future strip, which once again is upward sloping, so you still have that problem. So the key takeaways from this second part of my presentation are that it should really be a good time to hedge, given that gas prices are coming off of 10-year lows and that gas price risk remains skewed upwards. But for all the reasons that I just described and that are listed on this slide, that's easier said than done, particularly over longer terms and for any sort of volume. As a result, thinking of wind as a long-term fuel price hedge would seem to be as appropriate today as it has ever been, even despite this low gas price environment that we're in. In fact, it may even be more appropriate today given the somewhat unidirectional nature of the gas bet. Of course, whether or not wind can provide this long-term hedge in a cost-effective manner is a separate question altogether, which I'll turn to now in this next portion by comparing the wind PPA prices that I showed you earlier to a range of long-term natural gas fuel cost projections. Now, there are a number of different ways that one might compare wind to gas. Here I've taken what is probably the simplest and most basic approach, and what is also perhaps the most conservative approach at least from wind's perspective, and I've assumed that wind serves only as a natural gas fuel saver. So in other words, I assume that wind serves only as a source of energy, not as a source of capacity, and that each megawatt hour of wind displaces 1 megawatt hour of gas-fired generation. Now, one advantage of considering wind to be only a fuel saver is that it, of course, eliminates the need to try and estimate wind's capacity value, which can be a bit of a challenge, particularly on a nationwide basis for the type of high-level, generalized comparison that I'm going to make here. It's also difficult to generalize about integration and transmission costs. Both of these costs would very likely penalize wind relative to gas were they included in this analysis, but both of them can be highly region-specific or even project-specific within a region. So in the interest of keeping this simple and given the high-level nature of the comparison that I'm making, I've chosen to ignore both integration and transmission costs as well. And I'd be happy to talk more about that during Q&A if that's of interest. On the other side of the equation, though, I've also ignored some of the benefits that wind provides. These include the limited capacity value that wind is able to provide, along with, of course, wind's pollution and carbon benefits. I'm also not accounting for the likelihood that wind acting as a fuel saver will also presumably offset at least some of the non-fuel variable operating costs of gas-fired generators as well. So if you think about a bundled wind PPA as conveying a package of energy, capacity, and RECs to the buyer, then what I'm essentially assuming here is that the capacity and REC components of these wind PPAs have zero value. So in other words, I'm equating the full bundled wind PPA price with just the energy component, and then I'm comparing that energy component to projected natural gas fuel costs. And then, of course, on the other side of the equation, as I mentioned, I'm ignoring integration and transmission costs. So this is by no means a comprehensive analysis, but I do want to point out that it's also not entirely an academic exercise, as there is some evidence that certain utilities, including one that has a very large wind portfolio, do think about wind in much the same way, and I will get to that a little bit later. Okay, in terms of the data needed to make this comparison, the wind PPA prices come from the same exact sample of projects that I described in Part 1. The natural gas fuel cost projections come exclusively from the Energy Information Administration, or EIA, which over the past few years has looked at a variety of natural gas scenarios, including 3 reference case scenarios, 5 other projections that consider variations in the size of the U.S. shale gas resource, and then another 12 that look at various natural gas export scenarios under differing base case conditions. So in all, there are a total of 20 different fuel cost projections of potential relevance. Right off the bat, though, I am going to trim that number down to 16 by getting rid of 4 of the 12 export scenarios. So these 12 export scenarios were originally defined in Part 1 of the Department of Energy's LNG export study. And these export scenarios were defined without consideration of international demand for LNG. Part 2 of the DOE LNG export study, which was released just a few months ago, did consider international demand and came to the conclusion that under low EUR conditions, so under, well, EUR stands for Estimated Ultimate Recovery, so under conditions where recovery from individual shale wells is not as great as was expected, under these conditions, domestic gas prices would be high enough that LNG exports would not make economic sense. So in other words, once you add in the cost of liquefaction, shipping, and then regasification on the other end, the all-in price would be too high to stimulate exports of U.S. gas. As a result, I've removed these 4 low EUR export scenarios, which, by the way, are also the 4 highest price scenarios, from further consideration. So here's what the various gas price projections look like. Before you squint too much here, there's really not that much need to focus on any individual projection here, because in future slides I'll only show the gray shaded area that encompasses the full range of relevant gas price projections, once again excluding the 4 low EUR export scenarios, which are shown up at the top outside of the gray range. And going forward, I'll refer to this shaded gray area as the cone of uncertainty. All right, with all that out of the way, let's move on to the first comparison between wind and gas. So here we see the gray cone of uncertainty, representing the full range of gas price projections that I just showed you, though in this case the range is translated from dollars per million BTU terms into dollars per megawatt hour using the average heat rate implied by each EIA modeling run. Overlaid on top of that in black, you can see the reference case or most likely projections from the last 3 annual Energy Outlook publications. The red line represents actual historical gas prices, and then the blue line represents the average PPA price from the full sample of wind projects that I showed you earlier, which again represents about 23.5 gigawatts of wind built since the start of 1998 and scattered throughout the U.S. So perhaps the first thing to note here is that wind PPA prices were very competitive with gas-fired generation from 2003 through 2008. Ever since the sharp drop in gas prices in 2009, though, the average wind PPA price from this sample has been above market, and looking ahead, it continues to lie above the 3 reference case fuel cost projections until the 2025 through 2030 time period. This means that if gas prices actually do end up following any of these reference case projections, which of course is highly uncertain, then existing wind PPAs, or at least those in my sample, will be above market on average until that time. But if instead you focus on the gray cone of uncertainty, you'll see that the average wind PPA price, so again the blue line here, enters that cone in 2015, so just a year or 2 out from now, and thereafter serves as an effective hedge against many of the higher priced gas scenarios that have been modeled by the EIA. So just to sum up, if minimizing exposure to these potentially significant long-term gas price increases is a goal, then this graph suggests that wind could certainly be one tool to help achieve that goal. Okay, whereas the previous slide looked at our full sample of wind projects going back in time, on this slide I'm focusing just on the most recent wind PPAs in our sample, and specifically those that were executed in 2011 or 2012. So recall from part 1 that PPA prices have fallen considerably in recent years, which makes this more recent comparison, focusing only on what might be considered current wind pricing, much more relevant. The downside here, of course, is that sample size is quite a bit smaller in this case, at just under 3.7 gigawatts. Nevertheless, what we see here is that these recent wind PPAs do appear to be quite competitive with gas, falling below the reference case fuel cost projections before the end of this decade, and then eventually falling outside of or below the cone of uncertainty altogether. It's important to keep in mind, though, that these PPA prices do reflect the receipt of federal incentives, and most notably the production tax credit, or PTC, which is currently available to projects that begin construction this year. If the PTC is subsequently phased out, which has been proposed by a number of parties, including OEA itself, then wind PPA prices could eventually increase by as much as $28 per megawatt hour in order to compensate for the loss of the credit in providing the same type of financial return to investors. And I should probably just note here that $28 is probably a bit extreme at the upper end. The true incremental value of the PTC is probably a bit less than that once you consider financing implications. Anyway, as you can see here, even shifting this very low wind PPA price curve upwards by this amount would result in a significant challenge to wind's near-term competitiveness as a fuel saver, though certainly some long-term hedge value does still remain, particularly in later years. So the key takeaways from this third half of my presentation are that even in this low gas price environment, wind can still be a cost-effective natural gas fuel saver, particularly among the most recent contracts in my sample. Without the PTC, though, wind will struggle with near-term competitiveness, but can still provide some long-term hedge value. And I would argue that, at least from a hedging perspective, this long-term hedge value is more important than whether or not wind is competitive as a fuel saver in the near term. And this is because short-term gas price risk can already be effectively hedged using the conventional instruments that I discussed earlier, including futures, options, and physical supply contracts. It's only when you try to lock in prices over longer terms that these conventional hedging instruments come up short. And this is where wind holds a bit of a competitive advantage as a very long-term price hedge. And so on that note, I want to end with just 2 slides that reveal how 2 very different buyers of wind think about wind and its long-term hedge value. So here we see some quotes from the Public Service Company of Colorado regarding its recent 25-year contract with the 200 megawatt Lyman 2 wind project, and I hope I pronounced Lyman correctly. The utility thinks of this contract as a fuel saver. That's basically what the first bullet says. Or in the company's own words, in the second bullet, they think of it as, quote, an alternative fuel with known contract pricing over 25 years that will displace fuels where the pricing is not yet known. That is the essence of the fuel hedge, end quote. And then the third bullet simply confirms that you can't really replicate this same degree of long-term price stability using long-term gas contracts because for the most part they simply don't exist. Google, meanwhile, is of course building data centers that will use a lot of electricity over the next 20 years, and so it sees value in being able to hedge its electricity price risk over these same 20-year periods. Google doesn't care as much about hedging its cash flows on a quarter-to-quarter basis, but rather is more concerned about long-term price risk. So even though it's apparently losing money and paying a bit more for wind at present, it just wants to ensure that the wind projects from which it buys power will be there in the later years when price protection could presumably be more important. So for both of these prominent wind buyers, the long-term hedge value that wind provides and is somewhat unique in being able to provide appears to be an important consideration in their purchase decision. Looking ahead, as wind struggles to compete with gas on price alone, and as the U.S. runs the risk of entering into another gas bubble or another overbuild of gas-fired generation like we saw a dozen years ago, greater and more widespread recognition of wind's long-term hedge value, just as PSCo and Google have recognized it, could help to keep the country moving down a path towards a more balanced and diverse power mix going forward. So that's all I have. Thanks to everyone for hanging in there, and I apologize again for the audio difficulties. Let me just note again that the webinar is being recorded, so if you missed anything, you should be able to go back and listen to it again once we have it posted on our website. So at this point, let me look to the chat box and wade through it here, wade through all of the I can't hear you messages to see if I can find a question. And if anyone has any questions at this time, please do type them in. Let's see. Okay. Here's a question. Some states have RECs. I presume that these weren't included because they separate out the environmental attribute from the electricity. There are PPAs that utilize RECs. Can you add anything on these projects? Just to reiterate, all of the PPAs in my sample are considered bundled PPAs, which means they include the RECs along with the energy and capacity value. So I'm not looking at prices, I'm not looking at contracts that strip off RECs and sell them separately, in large part because in most cases I don't have any information on how much revenue is being raised through the REC-only contract. And really what I'm trying to do here is capture all of the revenue that's available to these wind projects so that I can make a fair comparison to gas-fired generation. So hopefully that answers your question. Okay, next question is, why is the PTC marked at $28 per megawatt hour when it's only $22 or $23 per megawatt hour now? So $28 is sort of the pre-tax revenue equivalent value of the PTC. So keep in mind that the PTC is a tax credit, which means it provides after-tax revenue. So in order to generate the same type of financial impact on a pre-tax revenue basis, you need to gross up the value of the PTC by 1 minus your assumed marginal tax rate, and then the PTC is only a 10-year income stream, so you also need to levelize it over a 20-year period. So that's essentially the calculation that I went through, and what you find is that at least on a nominal basis, it yields roughly $28 per megawatt hour. Now I did mention that $28 is probably an upper bound in this case, and that's because if the PTC didn't exist, then presumably there would be less need to access tax equity, which is an expensive form of capital. So you would perhaps be able to finance your projects more cheaply, which in turn would effectively reduce the implicit value of the PTC. Okay, another question. Would you agree that risks to consumers from gas price forecasts being wrong are heavily asymmetric? And then it goes on to say, high projected fuel price leads to more energy efficiency and renewable energy with hedge value. Low gas price, that's wrong. With prices end up, okay, I think the gist here is if organizations forecast high gas prices, then that's going to stimulate more investment in renewables and efficiency, whereas if the EIA or other organizations project low gas prices, then that's presumably going to lead to less investment in these other technologies, and so the risk there could be asymmetric. I guess I would agree with that. I would also say that I think it's becoming more widely known out there that you really shouldn't place much faith in any of these long-term gas contracts. Long-term gas projections, because history tells us that they're basically all going to be wrong. So really, I think the safest thing you can do is to look at a range of plausible forecasts, which is what I try to do with this analysis. Okay, next question. How are these decisions on wind affected by where you are in the country? Okay, that's a good question. In a previous iteration of this work, I did break this out on a regional basis. You'll recall that I had one slide that sort of broke out the sample by census division, and the EIA does break out its gas price projections by census division, so you can look at this on a regional basis. And basically what I found from the regional analysis was that wind, as you might expect, looks very competitive in the U.S. interior, less competitive along the coasts, but the regional analysis is a little bit questionable because sample size in that case, once you start breaking up my sample into individual regions, the sample size gets fairly small in some cases, and it does raise some question of representativeness. Okay, what are the main differences between wind and solar energy as a long-term hedge? Okay, you could definitely do a similar type of analysis as I've done here with solar. Probably a few different considerations at play though. For one, you'll recall that I converted my gas prices into power prices using sort of the average heat rate to come out of the modeling runs, and that heat rate ranged from around 7 to 8 million BTUs per megawatt hour. So that's basically reflecting the heat rate of a combined cycle gas turbine rather than a peaking unit. That may be appropriate for wind. For solar, you might want to look at a higher heat rate to reflect that you're sort of competing with peakers in some cases. Also, my assumption here to sort of assume away wind's capacity value would probably be more problematic with solar because theoretically the capacity value of solar should be quite a bit higher given that it sort of follows the sun throughout the day and more closely follows peak prices. One other issue that you might have to contend with is that there are far fewer utility scale solar PPAs out there at this point in time than there are wind PPAs, which just might lead you to wonder whether you're looking at a real trend here or a real representative sample. Okay, someone else is asking how soon will the recording be posted. I'll try to do that within a few days. This is my first experience with this, so please bear with me a little bit. Okay, what inflation projections are you using for real dollar estimates in part 1? Okay, so to convert between, actually let me just go to the next slide where I have some information on how I did some of the conversions here. So basically I'm using the GDP deflator historically, so I'm using the actual GDP deflator historically. And then looking forward, because these PPA prices do extend out to 2040 in some cases, what I used was the EIA's projection of the GDP deflator. So I sort of merged those two series together and treated them as my way to convert between real and nominal dollars. Okay, next question. Okay, someone is asking how EIA's gas price projections relate to other maybe private sector sources. I don't have access to a lot of private sector gas forecasts, but the EIA does actually compare their own forecasts to some of the more prominent private sector forecasts that are often used. And they last did this for the Annual Energy Outlook 12 projections. And I did look into that, and I included, I think, a footnote on that in the paper. Basically, the EIA's projection fell in between the two other private sector projections that they looked at. So it doesn't appear to be an outlier. It appears to be sort of in between the two of them. Okay, any thoughts on how to quantify a value for the risk for purposes of a better cost comparison with fossil fuel generation? It's difficult to actually try and come up with any hard number that you might treat as some sort of adder to gas-fired generation or something that you might subtract from wind-fired generation. We have dabbled in that in the past. If you want to contact me offline, I could definitely send you some links to some of the past work we've done in this area. But yeah, let me just leave it at that. It gets tricky pretty quickly. Okay, next question. If the PTC expires next year, will the existing projects lose that benefit for the rest of the project life, or do only new projects lose the benefit? Only the new projects lose the benefit. So if you qualify for the PTC and then the PTC goes away a year later, as long as you qualified for it, you're entitled to get it for the next 10 years, or for the full 10 years. Okay, to what extent does hedging matter for utilities if fuel costs get passed through? That's a great question. To put it another way, who applies the pressure for a wind hedge if state PUCs, PSCs allow fuel costs to pass through? Yeah, so it's an important consideration, and it is true that utilities pretty often just pass the rising fuel costs through to ratepayers through different riders, and I think really the pressure has to come from the ultimate ratepayer. I mean, they're the ones who are going to be left holding the hook here if the regulators don't step in and try to moderate the pass-through practice to some extent. And I believe there are a few utility green pricing programs that are trying to, or that have actually, set up a wind product or a wind-based product that ratepayers can buy to sort of benefit from this hedge value. I think I'm thinking of Austin Energy down in Texas, for example. So you might look into that. Okay, next question. The PPA price in the future goes through roughly the middle of the cone, so wind PPA might also mean paying more. Did you look at the balance, any probabilistic assessment of the hedge value? So this sort of gets back to the question of, did we actually try to quantify the sort of the present value of or the present cost, I guess, of the hedge? And the short answer is that we did not. I tried to keep this pretty simple, made it more of a visual comparison, and that is something that we could do, but we didn't do it in this case. Okay, another question. Has LBNL considered a similar analysis but using wind as a hedge for natural gas used for heating? Obviously, it's a less clean long-term hedge or a less perfect long-term hedge, but you can buy wind in an electricity market with natural gas on and predicted to stay on the margin, which would provide a hedge for direct natural gas use for industrial heating. We have not looked into that. I will just note that the corollary to that, or the converse of that, is occurring to some extent in that in some markets where power prices are highly correlated to natural gas prices, wind developers have instituted price hedges through the natural gas market rather than through the power market, simply because the gas futures market tends to be more liquid than forward power markets. So-called dirty hedges like that are occurring in that direction, and I really haven't thought about trying to do it in the opposite direction, but at first blush, it doesn't seem like it doesn't seem like it would be too much of a, it doesn't seem like there would be too many impediments to doing something like that. Okay, next one. I think I heard you say something about the operating cost of natural gas plants. What do we know about the effects of adding more variable output wind resources, thus resulting in increased variable operating expenses for gas plants that are trying to act to follow loads minus short-term wind production? What I mean to ask is, will increased use of wind lead to increased operating costs for natural gas units? And if yes, what, if anything, do we know about the amount of added costs for the gas-fired units? In this report, we actually, as you may recall, we decided not to give wind any credit for offsetting the non-fuel O&M costs of gas-fired generation. And there are two reasons that I went that route. First, because the value of non-fuel operating costs for gas plants is fairly small. I think according to the EIA, it's somewhere around $3 per megawatt hour. And the second reason is for this very same issue that you raise, that there could be increased cycling of the gas-fired generation in order to help deal with the additional variability that wind injects into the system. And so, without really knowing what the proper offset is there, or where the true balance falls, it just seemed best just to ignore that value altogether. Now, the first part of your question asked, what do we know about it? I believe one of the major integration studies that's going on right now, I think a follow-up maybe to the Western study, is looking at fossil fuel cycling costs. I don't know that much about it, but I think I have heard that, and we could probably get you more information on that if you'd like. Okay, next question. Do you have examples of natural gas price and volatility adders analysis you found which you can share? Yeah, I would say look at the bibliography or the list of works cited in the report, and I think there's a link to the report probably in the email invitation that you got to attend this webinar. And I'd be happy to talk offline more if you need more references. Okay, what motivated you to do this analysis? Was it a reaction to anything? This is just an area of research that we've had sort of a long-standing interest in. I think the first work we did in this area was back in 2002. So it's something that we look at periodically. Why are we putting out this report right now? That has to do a little bit with the rather unique situation we're in terms of gas prices, where they've come down so much, and by many accounts, they are projected to stay low for the foreseeable future. That of course makes it harder for renewables to compete on price alone. It increases the risk that the U.S. maybe moves more towards one type of generation than another, rather than sort of pursuing a balanced portfolio. And let me also just add that we've been collecting wind PPA prices for many years now. We finally got the sample up to a size where it seemed like it was sufficient, where we could actually do something interesting with it analytically. So the result is this report. Okay. Someone's asking if I explained why there is so much missing data from some regions. I did get into that a little bit with ERCOT. ERCOT is exempt from FERC reporting requirements, so the West-South Central region in which Texas is located is pretty heavily underrepresented. It looks like this person is particularly concerned about the East-North Central region, which I believe is the Great Lakes region. Some of the contracts up there that I came across did have various elements that were not able to be quantified, and so I did not feel comfortable about including a lot of those contracts in my sample. So just so you all know, I really only include PPAs for which I am, virtually 100% certain of the pricing going forward. If I can't get to that level of certainty, I exclude them from my sample, and I think that's what's going on with the East-North Central region. In particular, some of the contracts in Michigan had various elements to them that I couldn't quite put a number on. Okay. That's it for questions from the audience. No one asked about this one, so I am going to go ahead and ask myself a question. Having done this research, I think probably one of the more relevant questions involves the simplifying assumptions that I made earlier. As you recall, I basically assumed away a whole bunch of things in order to keep the analysis simple. So those included transmission costs, integration costs, rec values, capacity value, and also this question of non-fuel O&M costs. So I think a relevant question is, what are you giving up by assuming those things away? And when you assume them away, are you biasing your analysis in any sort of way? So even though it is difficult to kind of generalize about some of these numbers, on this slide I did actually make an attempt to just put down some representative ranges that are based on most of the literature, or basically all the literature we could find going back in time on some of these issues. So up top you have transmission costs and balancing costs. For transmission, you might want to add $10 to $15 per megawatt hour to the wind PPA price to make it more comparable to what you're looking at in the case of a combined cycle gas turbine. For balancing costs, maybe add $2 to $5 per megawatt hour. And then on the other side of the equation, for rec values, if you assume maybe you can get $5, maybe $10 per megawatt hour on average nationwide for your recs, you could subtract that from the wind PPA price. The literature suggests that a representative range for capacity value could be anywhere from $0 to $15 per megawatt hour. And then again, this question of variable non-fuel O&M costs for gas, that might range anywhere from $1 to $3 per megawatt hour. So when you add those things up on both sides of the equation and then net them out, what you find down in the bottom here in red is that you're looking at a pretty small number that sort of straddles 0 on either side. So, again, these are all just rough numbers, but I think, this type of sort of high-level back-of-the-envelope analysis here at least provides some comfort that by assuming these things away, I'm really not unduly biasing the analysis in one direction or another. So I just thought I'd throw that out there. Okay, so here's one or two more questions. Here's one that says, because wind is a variable energy, what considerations were given for gas generation as a backup to wind? So that sort of gets at this issue of both capacity value and also balancing costs, which I just addressed here. So really, in short, you sort of need to try and adjust your PPA prices or your, the cost of your gas-fired generation to account for the fact that wind and gas are really not the same type of animal here. Wind is not necessarily dispatchable in the way that gas-fired generation is. And as I just ran through here, these would appear to be representative cost ranges that you might use for that purpose. Okay, let's see. All right, that appears to be it. So let me go ahead and end the call. Right now we're almost at the top of the hour anyway. So thank you all for joining me again, and if anyone has any follow-up questions, I'd be happy to talk offline. Thank you very much.
Thank you. Please stand by.